Richard Dobbs, in your new book, No Ordinary Disruption, you say the forces changing the economy today are multiples of what we saw during the Industrial Revolution. So I guess we're getting rocked on a daily basis and we don't even know it, right?
I mean, we've all got a problem. We have built up our intuition over the last 30 years of our business lives, as investors, business leaders, and the world is changing. We're getting four forces larger than anything we've ever seen. We're having all four of them colliding at the same time, such that our intuition about how the world works could be wrong. So when we make a decision, whether an investment decision, whether it's a business decision, whether it's about how our family, we actually may be getting the wrong answer if we rely on our intuition. We need to reset our intuition.
All right, let's go through those four forces. The first one is that the economic centers of gravity are moving towards Asia. So I guess people who are saying this will still be the century of America are wrong. It's going to be China, right?
Well, America's still going to remain very important. But we're growing the urban population in emerging markets by 65 million people a year. That is, 10 times, doing something that's 10 times as fast as the British Industrial Revolution and 300 times the scale. So we're seeing a force of 3,000 times the Industrial Revolution, resulting in a huge increase in consumer class in some of these countries. America's still going to remain very important. There's a lot of innovation happens here. Just because it's not necessarily going to be the largest economy in the world by the end of this century, it's still going to be very important.
Well, let's talk about innovation, because the next force you say, which is moving the world, is that the pace of technology adoption is going to shorten the lifespan and the life cycle of companies. So does that mean that CEOs should make their plans more short-term?
I think CEOs need to understand how the world's changing. I think not necessarily being short-term, they need to spend more time looking out, understanding how the world's changing, who the new competitors are, and they need to make sure their companies are agile to respond. The agile companies can respond quickly. There are other CEOs that will be running agile companies that will be in place for a long time. So I think the key thing for CEOs is to understand how the world's changing and be agile.
And then the next force, you say, is that the aging population is going to lead to a population plateau. So we keep hearing that the world is getting older. What does that mean for the economy?
So if we think about the last 50 years, we've globally grown at 3.5%. Been great growth driven by productivity, but also driven by positive demographics. We've grown the number of people. As we look going forward, the growth rate is going to fall, unless we get a step change in productivity, to only about 2%. So we're going to be living through a 50-year period where the growth rate is going to be closer to 2 rather than 3.5, because of the fact that we're no longer going to be having a growing population. There's some good news about not having a growing population. Some of the climate change is going to be easier to deal with when we're not growing the population, but there is going to be a much lower level of growth, and that's a challenge for companies because you don't have the growth there. It's also a huge challenge for governments. If you think about governments' debt obligation and social commitments, that's a big problem.
And the fourth force you cite in No Ordinary Disruption is that the trade channels will be changing. So the trade routes, it's going to be between emerging markets as opposed to Europe, America, and then Asia.
Yeah. The world is, the fourth force is we're going to be more connected. Trade, finance, other things too. A completely random example. Greece, as a country, has been in default on their debt 50% of the time since independence. It didn't matter whether Greece defaulted or not 20 years ago, unless you were a banker lending to Greece, but it really didn't matter. We've now connected Greece up so that a shock that happens in Greece, not after all a black swan event, something that's happened 50% of the time, suddenly becomes a major crisis. So the issue we have is the world is much, much more connected. That has huge positive effects, but it can also have massive negative effects. A shock can spread around the world very quickly.
And then finally, what does this mean for investors, for long-term investors, as everyone tries to be? How can we take advantage of these four forces and maybe profit from them or secure our retirements?
Well, the first point is that we've had a wonderful period for investment returns. We've had great global growth, as I mentioned. We've had falling interest rates, so that's driven up asset prices, whether that be houses or whether that be stocks or bonds. That will come to an end. We can't get interest rates falling any further. The Swiss are trying to get negative interest rates, but most places are not going to have that. So I think we've got to be used to lower beta-type returns going forward. We're going to be in a world where beta returns are going to be lower. The good news, though, is these discontinuities create even more opportunity for alpha, for finding ways of actually beating the market. So I think the investment game is no longer going to be rising with the market, which has been, after all, a huge source of advantage over the last 50 years. But it's now going to be a game of actually understanding how to beat the market by spotting how a discontinuity like one of these forces is going to change a business and being able to bet on that.
Thanks a lot, Richard Dobbs.
Thank you very much.
Thank you for watching The Street.